And a little bit about you is that you are an accomplished entrepreneur, businesswoman, and real estate investment professional. You're a fourth generation farmer, which is so cool. You began working at a healthcare insurance company while in college and launched your own insurance business 2 years later. You got politically involved in the 2008 and began investing in real estate in 2021. Then you became a general partner in 2022. You're a general partner and investor relations at Massive Capital.
I'm gonna share really quick the slide because I think you wanted to talk about it. We're gonna get into the good stuff, right? Like how and what kind of insurance we can use or you use in particular to build this real estate portfolio.
Yeah, yeah. And what I wanted to talk about tonight was because I had all of this knowledge and experience in all these different kinds of insurance products. Um, Instead of using the tools to invest in the stock market with stocks and bonds and mutual funds, these four different insurance products that you see up here on the screen: health savings accounts, whole life insurance, universal and variable life, and old 401ks from a previous job, are all tools that you can use in certain ways to invest in private equity and real estate opportunities. Okay. And so when I was working specifically selling whole life, universal life, variable life, that kind of thing, we would talk about using the cash values in those products to then pull it out and then invest in a mutual fund or invest in a stock, because you can make more money in stocks than you can in the whole life policy that maybe returns 4 to 5%, and you can get a 4 to 5% from a money market. You know what I mean? So, as an insurance agent, what we would do is we would talk about these whole life, universal, and variable life products in particular, and discuss with the client how you can leverage the cash value in these products and then use that money to invest in something else. And that something else can also be real estate. So, if you want to flip the slide, Jazz, we'll just go through a couple of these products, and I'll give you more specifics about them. So, understanding what an HSA is and how to invest with it. So, back in 2006, the government put together a specific high deductible health insurance plan that they started offering all across the US. And employees didn't like the idea because in order for you to install a health savings account, you had to have one of these high deductible health plans where nothing was covered until $3,000 was paid. And so it didn't catch on right away. But what employers started to do is they would fund a savings account for the employees and then not have them pay anything out of their paycheck to enroll in this plan, in lieu of enrolling in your typical, you know, $500 deductible, $20 copay plan that you were used to having. And those of us in the insurance world immediately signed up for these HSA plans because we saw them as a vehicle to save money and not pay taxes on the money. So first of all, it goes in with no tax. So if you have an employer that offers a health savings account to you with a high deductible health plan, when they put that money out of your paycheck into that savings account, it does not get taxed. It doesn't get taxed by Medicare. It doesn't get taxed by Social Security. It doesn't get taxed by FICA or FUTA or SUTA or any of the taxes. It literally comes right off your $1,000 you're getting for the week let's say you're putting 200 in, and it immediately goes into this savings account for you. And there's some rules around these health savings accounts. You can't have them in place unless you have one of these high deductible health plans that you purchased for your medical policy. But if you do that, you can, this year in 2024, you can put up to $8,150 without paying any taxes on it into this health savings account as a family or a couple. And why that is so awesome, okay, is because that money again goes into the account tax free. It also earns tax free. So if you take the $8,000 and over the next 5 years, you make a 20% return on your investment with it, that 20% return of the $8,000 also is tax-free and grows tax-free. And here is the super duper wonderful benefit. Number 3 of a health savings account. And this is the only time this ever happens in the history of taxation. When you spend it for eligible medical expenses, that 20% return, that original investment of $8,000, as long as you're spending it on a medical expense, it's also tax-free. So you never pay tax on this money, ever. As long as you follow the guidelines. So you know the whole adage, you know, everybody dies and pays taxes. Not if it's in an HSA account, you don't. So you can actually put it in tax-free, grow it tax-free, and spend it tax-free as long as you follow the rules. Okay. And a lot of people since 2006 have been building up these health savings accounts. I'm one of them, right? And because I knew the value and the beauty of this as a financial, person and a person who's in insurance, I told my husband, we're not spending a dime of this money towards medical expenses. We're going to grow this money because when we are 65 or 70 and we don't have health care from our employers anymore, we're going to need as much money there as we possibly can have to help pay for all of these medical expenses that we're going to have when we grow older. And so what we've done with our HSA account is we've taken money through our health savings account custodian. And some people have their HSA accounts with Health Equity. Some people have them with their banks. Some people have them with large HSA, bank companies. But there are custodians out there that allow you to put your money into a self-directed health savings account. And because it's self-directed, that means you can invest those dollars in any type of private equity type investment. Obviously there's risks. Obviously, you don't want to put your stuff in super risky things because this is your medical savings money that you have. But directing some of these dollars into other types of investment tools can really help you grow these dollars that you've got to have when you're an aging person after you retire, right? And so I wanted to talk a little bit about that because those of us who are in the private equity space and we are accredited investors and we look at all these different opportunities, don't often think about this health savings account that we might have that has a decent amount of money there that could be invested. Okay. So that's one of the tools I wanted to share this evening because I don't hear many of my peers talking about this particular type of self-directed savings account for investing. So if you go to the next slide, Jazz, we're going to talk a little bit about these numbers. Now, this is an employee only coverage. And so here, this just gives you some stats about the potential balances that employees across the United States have right now, because like myself in 2006, so that's 16, you know, it'll be 26 years in 2026. So I've been, saving this money for 20 some years, basically. And you're only allowed to put in certain contributions. So you'll see here that like a single person can only put in 4,300, but if you're a family, you can typically double those dollars, is how it works. So it's not a ton of money that you're going to be putting in every single year, but you can see quickly how you can grow these balances if you're being wise with the investment part of the actual bank account itself. So these are just some ways that we share with our employee groups on how they can start really making sure they have the money they need for health expenses when they retire. And then if you want to go to the next slide, we're going to just talk a little bit about whole life and the lives. So some people have what's called permanent life insurance, and some people have term insurance. The difference between term insurance and permanent insurance is term insurance, you pay a certain amount of money each year for it. And as soon as you quit paying for it, it goes away and the benefit is no longer there. When you buy a permanent life insurance policy like whole life, universal life, variable life, you pay into the policy. It costs more than a term life insurance policy, but a certain portion of the premiums you pay every year have a cash value to it, and it kind of grows in a fixed interest rate. So it's almost like having a little money market account inside of your life insurance product. And what's nice about these permanent life insurance policies is you can pull out the fixed money that grows in the policy and then use those dollars to pay for things. So you can just pull them out and buy a car with it, buy a house with it, right? Um, and then have a loan out for the cash value, okay? And you can either pay the cash value back or never pay it back. And then when you die, it gets subtracted from the amount of life insurance that's supposed to be paid to the beneficiary, okay? And so those types of whole life or permanent policies are great to buy for a very young person. I bought these policies for my kids when they were born, okay? And right now, my son has a decent amount of cash value built up in his whole life insurance policy. And he could pull the money out and invest it, or he could spend it, put it as a down payment for his house, or he could pay for his college with it, because there's certain dollars and certain things that mom's not paying for college, so he can pull it out and use it for that, and then later decide to either pay it back or not. Because if he doesn't pay it back, then the life insurance policy will be surrendered, and there will be no benefit upon his death, is the downfall of that. But that might not be a problem if you're not needing it for anything, right? And so people will have these policies because maybe their grandma bought it for them, their mom, like me, bought it for them. They have the policy in place and they had no idea that they could use the cash value in that policy for certain things. And one of the things you can use it for is investing. And so there's tax benefits, for that too. And that's why I listed that. And so if you want to just flip to the next one, we're going to just go over that one really quick, and then I'll open it up for questions.
Yeah, I already have my first question.
Yeah, this is a universal life insurance policy. It's a little bit different. The premiums are a little bit different. The cash values work a little bit differently. Um, the way the premiums come and go are a little different. So I just wanted to have that information, and you can do a screenshot, or we can send this to you afterwards. We can send this out. And then if you want to go to the next one, Jazz, we'll just talk about the variable life. Variable life policies were really, really popular. You know, they started getting very, very popular about 10 or 15 years ago. And so these are more of the policies that you see are these variable life insurance policies today versus the universal policies that we sold originally. So, and they're just structured a little differently, and I can't go into all the details, but if you're interested in these kinds of policies and you want to reach out to me, just send me a DM, or reach out, and we can talk more about them. If you have them, I can give you some advice. I'm not a tax attorney, I'm not a CPA, but I can give you some guidance, on some of this kind of stuff. So
It does lead me into my question, and I was kind of talking in the chat about this, about investing, for example, in Candela. Candela is our newest opportunity. It's a retail development that we have right now, and how we can leverage our, like, something that we're just talking about, how we can leverage this to actually invest in that, and how you can use these insurance, like how can we do this? How can we leverage this to invest in Candela? And you basically talked about that, how we can use these to invest in Candela. You just kind of walked us through it. And Candace, can you talk about like how companies, how custodians, again, we're not financial advisors, but can you talk about how directed IRA, for example, how outsourcing, how talking to directed can help
sure.
start
Yeah.
the
I mean,
process?
Directed's one, Inspira is one,
Yeah.
Advantage IRA is one. There are niche custodians that will work specifically with these different types of accounts and help you um, combine them, I guess, is the best way. In some instances, you can combine them. In some instances, you can't. Like, for example, you can't take the HSA account and combine it with one of your individual self-directed IRA accounts. What you have to do instead is you have to set up a self-directed HSA account. So it's different because it has different rules. As if you remember at the very beginning when I said the HSA is the only account that you could spend the money tax-free, right?
Mhm.
That's not the case with your IRAs, right? So there's a lot of rules, and you need to
Yep.
work with an advisor, and you need to work with your custodian. And so I can give you high level overview, right? But you still need to talk this through your tax attorney. You still need to talk this through with your CPA.